So I want to kind of talk about some of the news that has been happening this week. And, the biggest news starts with reports of President Biden wanting to double the capital gains tax rate. And so the capital gains tax rate plus the surcharge, which is basically an additional tax on top of the tax rate, which is kind of pointless anyways, to not include it in the capital gains tax rate because you're going to have to be paying it anyways. And so I'm just going to be talking about the capital gains tax rate plus the surcharge because that's what you're paying. It doesn't matter if you call a dog's tail a leg. I mean, it's still a tail, and so it doesn't matter what you call it. It's just more tax. And so the actual capital gains tax plus the surcharge right now is 23.8%. And so President Biden wants to increase it, the maximum capital gains tax rate to 43.4%. And that's the long-term capital gains tax. So that's actually higher than the short-term capital gains tax. And, apparently he wants to make this so that the new taxes only apply to people with, income tax over 1 million. But of course, that's also going to have, a ton of trickle down effects because, you can't just tax people and expect no other things to happen from it. And so, this is not necessarily good for the US stock market, obviously. And, on that day that the report came out, that caused the markets to fall around 1%. And the thing is that it's only a report. So, it hasn't been implemented yet. And if it is implemented, I mean, who knows? You could have markets fall 5, 10, maybe 20%. I mean, anything is possible. And so that, points a direction for a lot of people with a lot of assets, especially stocks and real estate, to maybe look to move out of the United States and maybe move into, places without capital gains taxes or with much lower capital gains taxes. And I was looking at some countries without capital gains taxes, and a few of them are Hong Kong, Singapore, New Zealand, Switzerland, and an interesting thing I found was that Malaysia also doesn't have a capital gains tax, and I'm pretty sure they don't even have a dividend tax. And so basically, anybody who owns assets in Malaysia is just getting no tax from their assets. They're not getting taxed from getting rich off of their assets. And, I'm not exactly sure how the tax code works there. I mean, I could be wrong. Maybe you're going to have to pay some type of, tax on your dividends if you make a certain amount. I don't know. But I guess you would call it the official tax rate there is 0%. And, what's interesting about Malaysia is that it's not like Hong Kong, Singapore, New Zealand, or Switzerland, because these countries are already, quite well established small countries. And, these countries are the ones that have implemented these, good policies that promote businesses, that promote investing there. And so that's why these countries, although they're very small, they're very, strong at least per capita, and they have very strong economies relative to the country size. But what I saw with Malaysia is that Malaysia is an interesting. It's an interesting case because it also has these very, very good policies for investing and for starting businesses, but it's not established like Hong Kong or Singapore is, and it doesn't. It's also not a very expensive place. Like the cost of living, the real estate there, it's actually quite cheap. It's kind of like the other Southeast Asian countries, which are, the stuff there, the cost of living is pretty cheap. And so that, looking at that alone, you could think that Malaysia has a pretty good, economic growth prospect. And I think to a reasonable degree it does. And so, I might look into there a little bit, into Malaysia a little bit more. But, you also have to look at how are the uh, government policies there like, what are all of the kind of the political risks and social, cultural risks that come with, different countries. So from the, policy, from the economic policy perspective, I think it looks great, at least from taxes. But I mean, I don't know, because there's so many things you have to look out for when you're going to especially a small and undeveloped country or underdeveloped country. There's many, many risks, but your return is also much, much bigger. And again, these Southeast Asian countries, I think, are a lot less overvalued than countries like United States, and especially the developed economies, because everyone's pouring their money right now into developed economies, especially the United States, into U.S. equities. But well, I mean, the emerging markets have kind of done pretty decently lately. But I think there's still a lot more room for these emerging market uh, equities to grow relative to U.S. equities to grow, because I mean, the whole value of these emerging market equities are a lot cheaper. They're a lot cheaper. The price is much lower, and their earnings relative to price is lower, and their future prospects. If you're predicting future earnings, they don't look much worse than the United States, and they might look better as well, if you're looking at percentage growth. So I think that a lot of the emerging market economies could benefit a lot, but something you have to look out for right now, at least in the short term, is India, because India, the whole COVID situation there is just placing a huge, huge burden on their whole economy and their whole political and social situation, because India is a very, very tight place, and they're not implementing like super rough like authoritarian policies like China did, which worked quite well in controlling COVID. But then, of course, you have to give that power to your government, and that's not something that the U.S. would do. That's not something that Canada, that Australia, Europe. It's not something that these countries would be able to pull on their citizens. But a country with a more powerful government like China could do. And sometimes with anything, you have a cost and a benefit. And most of the time when you have your government this powerful, you have a lot of risks associated with a lot of things that just are pretty obvious. And your government can do pretty much anything against you, but sometimes you also have the benefits of these, and if your government uses them correctly, these powers correctly, then it could actually benefit your country. And so the problem with actually giving your government too much power is, over the long term, you're going to get some corrupt government officials. You're going to get some corrupt politicians, and these guys are just going to destroy the whole country, because it takes a long time to build a good country, but it could be destroyed very, very quickly and very, very easily. And so, big risk, big return type thing. If you're just looking at total aggregate efficiency and just the total benefit, and if you're not taking a look at just kind of the individual freedom. But I think the individual freedom is important there as well. But talking about individual freedom and going back to the doubling the capital gains taxes, I mean, that's kind of scary because the capital gains tax becomes higher than the personal income tax if you're going to double it. And I mean, that doesn't make any sense at all. If you're going to have a capital gains tax that's higher than a personal income tax, although I don't think the personal income tax should be that high, and I don't think really any tax should be that high. But I think what's more scary than these high taxes is that they're not going to be able to pay off nearly what the U.S. government owes and what it's borrowing from in 2020, because you could have 43% capital gains tax, you could have 80% taxes. It doesn't matter. There's still no way that you could generate enough tax revenue to actually be able to pay off your existing debt and to pay off all the money you borrowed. Because I mean, at a certain point, if you raise the tax rate so high, then you're just going to be diminishing your tax returns. And that's the Art Laffer kind of equilibrium graph type thing. But I don't want to get so much into the whole details, and I want to just wrap this little part up by saying that I don't think that actual taxes are going to be the most dangerous or the most painful thing you have to go through. And I think they're, well, to some degree necessary to fund all the spending. And you're going to be taxed anyways, because if the spending has been done, the taxing cannot be avoided by the nation as a whole, unless if you default, that is, which a lot of it is going to be just you defaulting on your own central banks, which wouldn't really do anything. And you're also defaulting on foreigners, which would do something. And so unless if the US government's going to default, which I don't think is going to happen anytime soon, then it doesn't really matter how much you raise the taxes. You're going to have to pay a lot more than the taxes that you're already paying. And, I don't think the US government should default on their debt, at least not now. If you want to look at the benefits of the United States, if you want to look at it from a perspective of having maximum benefit for the US, because, I mean, if you're going to default right now, I think that's the more responsible thing to do. But if you could default in the future, that you're benefiting a lot more, because think of it as a consumer. If you have $1,000 on your credit card and you don't want to pay it back, so you declare bankruptcy, well, why not do it when you have 1,500 or 2,000, right? Why would you do it with less money? Why would you declare bankruptcy when you have less money, when you could do it with more money? And so that makes sense, except it's, the foreigners are going to be a lot more mad. And what's going to happen is the dollar is going to drop a lot more if that actually ends up happening than if you had less debt. But, regardless, if you want to somehow get your debt problem dealt with, you're going to have to just demolish your currency anyways. And that's not necessarily exclusive to the United States. It's, a global thing. Now, the US is most at risk, not necessarily, let me reword that. It's not necessarily the highest risk country, but it has the most to lose. It's got the reserve currency, which it just allows the US to have these massive trade deficits. And to some degree, it's almost impossible for the US to not have these massive trade deficits, because the US does have the reserve currency. And so you kind of have it's obviously a benefit of having the reserve currency, but at the same time, you have to be constantly kind of running these trade deficits, because other countries need US dollars. And so they're going to just offer you their stuff for such low prices that you can't not buy it. And, think of it as you have this magical money. Whatever money that's in your wallet, it just turns into magical money that everybody wants. And so now, whenever you go into the grocery store or any store, everybody's giving you 90% off discounts. Well, you're going to be buying everything with your money. And so that's kind of the case with the US when you have a reserve currency, except it's not 90% off. It might be like, 30 or 20% off, but they're kind of offering you stuff at a discount, and they're doing that, a lot of it, by reducing the value of their own currency. And so, you have stuff like, you have countries like China who are debasing their own currencies to basically let Americans buy Chinese goods for cheaper prices. Except, and you had Trump calling that, like currency manipulation or something, which, I mean, it is currency manipulation, but I mean, every country does it, but it's for different purposes. So instead of, just pegging your currency to another currency, I mean, like central banks around the world are controlling the prices of their currencies. They're changing their interest rates. They're changing the money supply. They're increasing credit, debt. And so, I mean, every country in the world who operates in a fiat system basically manipulates their currencies. But this does not end well if you have so much debt and if you're constantly running all of these large trade deficits. And especially, it might benefit the markets in the short term. But, the thing is, what happens when COVID is gone? And what happens when the markets return to normal? Because, I mean, it's such a, how would you say it? It's such a crazy thing, because the markets are doing incredibly well right now. I mean, obviously, and I read an article, I think it was the Bank of America released this study that basically claimed that in the past 5 months, more money has been poured into equities, globally speaking, than in the last 12 years. And if you look at the fundamentals of companies and of earnings and of whatever valuation metric you want to value companies, in the past 5 months, the companies have not increased. Their fundamentals have not increased more than they have in the past 12 years. It's just absurd how much money has been poured into these equities. And so, I mean, eventually, once COVID ends and once the economy gets back in shape, the central banks around the world are going to have to move back and change up their policies and basically go back to, try raising interest rates, which might not necessarily be successful, but at least I think they will, to some degree, try doing it. And, I live in Canada, and apparently the Bank of Canada right now is looking to raise interest rates maybe in the next year. And so, the Bank of Canada has slightly turned a bit more hawkish, whereas Jerome Powell at the Fed is still quite dovish. But anyways, after COVID, I mean, and after all these lockdowns, and after just everything gets sort of back together, except a lot more debt, you're not really going to have much of an excuse for the central bankers to keep interest rates this low, to keep on throwing out their monetary policies. But of course, the governments want to keep on spending, so they're going to just throw out all these fiscal policies, regardless of how the economy's doing. But I think that matters as well. So they might cut some of their stimulus checks. I mean, who knows if there's going to be a fourth round of them? But if there are, I mean, why raise taxes anyways if you're just going to throw money back at people? Doesn't make any sense. Well, I mean, because right now all the poor people are going on Robinhood and making all of their income there. So, I mean, you're kind of just taxing the poor. And if you're taxing Robinhood, then you're kind of just taxing the man who taxes the poor. And so, I mean, but once you get after COVID, after all of this gets back together, when the central banks try to raise rates, the market might be affected in quite a negative way. And, especially once the whole international trade system, because, right now the US is running huge trade deficits and probably the bigger deficits than it's ever run. And I think a bit earlier, Trump came back and somewhere on television or something, and he said, this is like Biden's fault. But I mean, it's kind of ironic because when he ended off his presidential term, the trade deficits were the biggest in U.S. history. Except they're just bigger now because we're further into the future. And I think maybe some of Biden's policies worsened the trade deficit, but it's not like the trajectory of Trump's trade deficits were very good. And so, I mean, he obviously didn't really win the trade war, which for some reason some people think he won. Because I mean, if you win the trade war, then maybe your deficits aren't huge, and he basically stopped at his first phase one, and got canceled because of the whole Chinese coronavirus thing. And so when everything there gets back together, the U.S. might have to start importing again or exporting again, which would put even more demand on stuff like commodities. Because right now, what you have is you have such a big, you have so many companies with so much capital and so much access to capital, so much access to debt, that these companies have to do something with the money. And so either these guys could buy back shares or pay them out in dividends, which right now is less than favorable because Biden wants to raise the capital gains tax. So right now buying back shares is less than favorable. But let's say they wanted to pay them out in dividends, that's a possibility. But some companies might, and a lot of companies I think might look to try to buy into or produce new goods and services or build new infrastructure. Biden's trying to do that with his new $2 trillion plan. And, who knows how many trillions it's going to be. But as of now, it's somewhere around 2 trillion. And so, I mean, with all this production of new infrastructure and all of these goods and services and consumers getting all of these food and goods and services, that's going to take a lot of commodities because those are the building blocks of production. And if you want to build a TV, you want to build a car, if you want to eat food, I mean, you're using commodities, agriculture or metals or whatever you need. It comes back to commodities. But if you look at the commodities inventory, they're shrinking and they're not looking like they're increasing. And so these companies are probably going to have to pay a lot more for commodities in the future. And when they do that, well, you kind of have a situation where the prices of their expenses, the company's expenses are going to be so high that they're going to have to pass them down to their customers. Now, that's if they can, and that's why a lot of tech companies just do so poorly during inflation because they can't pass down their costs. They can't pass down their rising costs because nobody wants to pay extra money for a lot of this technology. But some consumer staples, if you look at Walmart or something, it doesn't matter because you have to eat, you have to buy clothes, you have to just buy your basic needs. And so, it doesn't matter how much Walmart charges you, as long as as long as Walmart's competitors aren't charging less because they can't afford to, then your only pick is Walmart. So you have to basically buy anything that they and buy stuff that at any price that they offer to you. And the same goes with stuff like utilities, except the stuff with utilities, it's heavily regulated, and so the utility companies can't just charge an absurd price for their stuff, and so, but I think that the regulators will always allow them to come out as profitable, so they won't make the utility companies be able to charge so little that they're losing money. But with all of this, I want to get to the point where I think the market after COVID is going to be a lot worse than it is pre-COVID. And the reason is because just a lot of these monetary policies are going to slow down. A lot of these fiscal policies are going to slow down. And the vaccine was apparently great news for the markets, but so was the massive amounts of stimulus, market stimulus that came with COVID. And so basically right now we're in a situation where COVID is great news for the markets, and the COVID vaccine, which ends COVID, is great news for the markets. Now the point is, the policies, the stimulus is the great news for the markets, not COVID or the COVID vaccine. Except when COVID ends, what you're going to get is stimulus ends, or at least slows down or becomes smaller. And the markets right now are just heavily reliant on stimulus to continue increasing. Now, an important distinction is that the real economy is not getting better, and it's different from the markets. It's different from stock market. It's different from the real estate, and it's supposed to be similar, and it's normally similar, except when you have just this massive wealth redistribution, and that's basically what monetary and fiscal policies are, just wealth distribution. When you have all of this, the real economy is still getting worse, but the financial economy, the markets, the assets are getting better.